What's up YouTube? This is The Working Investor. Today we're going to talk about if you can beat the market with the Russell 1000, and we're going to compare two of my favorite ETFs, the SPY, which is the S&P 500 ETF, or the VONG, which is a Vanguard Russell 1000 Growth ETF, and why beating the market even by a few percent makes a tremendous difference in the span of 20 to 30 years. Let's get started. So before we get into the ETFs, some things to consider is the market cap size. The larger the market cap, the less likely they're gonna bust in a downturn market. Larger companies tend to have more financial fortitude. Another thing to consider is what type of class is it? Is it a growth class ETF? Is it a value class ETF? Or is it a combination of the two known as a blend? When you think of growth, think of like Tesla, Google, companies that are reinvesting in themselves, not really giving much dividends and some money back to the consumers, but giving you more growth. Value, you want to consider like your retail, your Walmart, your Target, that do give you a little bit more dividends back and to have better PE ratios. Another thing to consider is the history of the growth. How many years do you have history of this company, and have they consistently beating the S&P 500 expense ratio and dividends? We'll get right into it right now. Let's look at TD Ameritrade. They have a really nice way of analyzing the assets. So here you have the Vanguard Russell 1000 Growth Index Fund ETF, and you can see here that it is a large cap, but it does also include some mid cap because it's the 1,000 largest companies, which does encompass some mid cap ETF, and it's a growth. And you can see it has a really small, minuscule expense ratio. It has a small amount of dividends, and that is expected because this is a growth. And you can see this little button where you can compare it to the S&P 500, and you can see that it is crushing the S&P 500 over the past year. You can go back on performance and take a look at the last 10 years and how it has been crushing the ETF of SPY, or the S&P 500, and you can see that it's been returning about 16.49% or 17.64%. So if you do a side-to-side comparison, so you got your SPY, you got your VONG. So when it comes to cap, SPY, they're both large cap, but the VONG includes some mid cap. Asset type we've already discussed. Expense ratios we've already discussed, and you can see that VONG beats out the SPY expense ratio by a little bit. Dividends, we can see that the SPY is doing a little better with dividends, but again, it's a blend, so we can expect that. But when it comes to 10-year performance, you can see that VONG is crushing the SPY by a few percentage. And if you want to add dividends to your performance, because that is part of your performance, you could still see that the VONG is outperforming. So who's the winner? VONG, but it can be both. And I'll explain why. There is something called tax law harvesting. And tax law harvesting is very beneficial when you have companies that are correlated but they are different. And what I mean by that is, if you go back into the chart, so this is the VONG chart, and you compare it to the S&P 500, this is a 5-year range. You're going to see that they both kind of have the same patterns of ups and downs, but of course the VONG is outperforming. But when there's a downturn market and you are a long-term holder, a lot of people would sell one asset and buy another, and they can have a paper loss, and that can save them some money on some taxes. Again, I'm not an accountant, not a financial advisor. Please look into it and take your own risks and speak to your own accountant. More importantly, why does it matter if you make a few extra percent on the market? It matters because if you look at this calculator that I found, it's called investor.gov, you can see that if somebody were to start with $1,000 and contribute $250 a week or $1,000 a month over a period of 30 years, and you get the rate of the SPY of 15.71, which is adjusted for dividends, you would have a total return of $6 million. And this is the kicker right here. The total contribution was only $361,000, but the value is $6 million. Again, past performance is not indicative of future gain. Now, you saw that $6 million right there on the SPY. Now look at what a difference it makes when you have a couple extra percent return that's crushing the market. So over 30 years, the same scenario, it would be, instead of $6 million, it would be $8,170,000. So additional $2 million in your pocket just because you chose a higher paying asset class. Same thing, you would only contribute $361,000 over the lifetime of the investment, and the return would be $8.17 million. Again, past performance, not indicative of future gain. This is just a hypothetical scenario. If you like this video, please give it a thumbs up. Thank you so much for watching and supporting this channel.